trading, while potentially lucrative, is inherently risky. Market risk, the most fundamental type, stems from the unpredictable nature of price movements. Even seasoned traders cannot predict market direction with absolute certainty. Liquidity risk arises from the possibility of being unable to exit a trade when desired. This can occur in thinly traded markets where there are not enough buyers or sellers to facilitate a transaction at your preferred price. Psychological risk is often overlooked but equally significant. Fear, greed, and the desire for revenge can cloud judgment and lead to impulsive actions that increase risk exposure. Understanding these various facets of risk is the first step toward effective risk management, which is crucial for long-term success in the markets. Many new traders fall prey to the allure of market prediction, believing that the key to success lies in forecasting price movements accurately. However, market behavior is inherently unpredictable. Instead of focusing on the impossible task of perfect prediction, successful traders prioritize risk management. They understand that losses are inevitable in trading. Effective risk management involves a set of principles and techniques designed to control potential losses. While you cannot control market movements, you can control how much you are willing to lose on any given trade. By shifting focus from prediction to protection, traders can approach the market with a more disciplined and controlled mindset, increasing their chances of long-term success. One of the most critical aspects of risk management is determining the appropriate position size for each trade. Position sizing refers to the amount of capital you allocate to a particular trade. A common yet potentially devastating mistake many traders make is risking too much capital on a single trade. A good rule of thumb is to risk no more than 1 to 2% of your total trading capital on any single trade. To calculate the appropriate position size, you need to determine your entry price, stop-loss level, and the amount of capital you are willing to risk. The formula is position size equals risk amount divided by the difference between entry price and stop-loss price. By adhering to this 1 to 2% risk rule and utilizing the position sizing formula, you ensure that even a string of losing trades will not cripple your trading account. Stop-loss orders are an indispensable tool for managing risk in trading. A stop-loss order is an instruction to automatically exit a trade when the price of the asset reaches a predetermined level. The primary purpose of a stop-loss order is to limit potential losses on a trade. Without a stop-loss, you're essentially leaving your trade open to unlimited risk, which can be disastrous if the market moves sharply against you. There are two main types of stop-loss orders: fixed stop-losses and trailing stop-losses. A fixed stop-loss remains at the same price level once set, regardless of market fluctuations. In contrast, a trailing stop-loss adjusts automatically as the price moves in your favor, locking in profits as the trade progresses. The choice between a fixed and trailing stop-loss depends on your trading strategy and risk tolerance. Section 5. The Risk-Reward Balancing Act, seeking favorable trading opportunities. A crucial aspect of risk management involves evaluating the risk-reward ratio of potential trades. This ratio compares the potential profit of a trade to its potential loss. To calculate the risk-reward ratio, divide the potential profit by the potential loss. For instance, if you're considering buying a stock at $100, setting a target price of $110, and a stop-loss at $95, your risk-reward ratio would be 1 to 2. A favorable risk-reward ratio is crucial for long-term profitability in trading. It's generally recommended to aim for a minimum risk-reward ratio of 1 to 2. Avoid trades with poor risk-reward ratios, even if they seem tempting. Remember, it's not just about winning trades, it's about winning more than you lose, and the risk-reward ratio helps you achieve that balance. Section 6. Diversification. Don't put all your eggs in one basket. Diversification is a fundamental principle in risk management, not just in trading, but in all aspects of finance. It involves spreading your capital across different assets, sectors, and even markets to reduce the impact of a single negative event on your overall portfolio. Trading in a single asset or market segment exposes you to concentrated risk. However, by diversifying your investments, you mitigate this risk. Understanding market correlations is crucial when diversifying your portfolio. By diversifying your trading portfolio across different assets with low or negative correlations, you can effectively manage your overall risk exposure. Remember, diversification aims to minimize losses from unfavorable events in one area by offsetting them with potential gains in other areas. Section 7. The psychology of risk, mastering your emotions in trading. While having a solid understanding of risk management techniques is crucial, mastering the psychological aspect of risk is equally important. Trading can be emotionally charged, and allowing emotions to dictate your decisions can be detrimental to your success. One common emotional pitfall is revenge trading. After experiencing a loss, it's tempting to try to win back your money immediately by placing impulsive trades. This often leads to further losses, compounding the initial mistake. Step away from the market, regain your composure, and only return when you can approach trading with a clear and rational mindset. Journaling your trades and regularly reviewing your performance can help you identify emotional patterns in your trading behavior. Section 8. Protecting your capital, the cornerstone of successful trading. Mastering risk management is not about eliminating risk entirely. That's impossible in trading. It's about understanding, quantifying, and managing risk effectively to protect your capital and ensure your survival in the market. Key takeaways for effective risk management include: never risk more than 1 to 2% of your capital on a single trade. Always use stop-loss orders to limit potential losses. Look for trades with favorable risk-reward ratios, at least 1 to 2. Diversify your portfolio across different assets and markets. Remember, in trading, sometimes the best trade is the one you don't take.